Welcome to another deep dive, everybody. Today we're diving into a world where numbers meet business decisions.
Oh, that sounds interesting.
And you've given us quite an interesting mix to work with today.
Oh, is that right?
Yeah, we've got a business statistics textbook,
Okay.
and then we got sections from a financial accounting textbook.
Sounds like fun.
Yeah, so it's all about making sense of data and using it, strategically to make decisions in a business context. What do you think?
Yeah, and I think what's really cool is that sometimes people think of accounting as just bean counting,
Right.
but it's not.
It's way more.
It's so much more than that.
Yeah.
And I think the thing that's really interesting is how these two fields actually complement each other.
Yeah.
Because accounting really is about using data to tell a story about a company's financial health
Yeah.
and, predict future performance
Right.
and, make sound investment decisions.
Exactly. So let's jump right into it. We both know that there are different types of data,
Right.
but what trips people up in real-world business is knowing which kind of data they're dealing with
Right.
and what that means for, their analysis. So what are some of the common pitfalls that you've seen in your consulting work?
Yeah, so one of the most common mistakes that I see is when people treat continuous data as if it were discrete.
Okay.
I was once consulting for a retail company, and they were measuring customer satisfaction
Right.
on this 5-point scale.
Yeah.
And they were treating those ratings as if they were discrete categories.
Okay.
But those ratings actually represent points along a continuous spectrum.
Mm-hmm.
And so by ignoring the continuous nature of the data, I felt like they were missing out on some valuable insights.
Oh, so they were like putting people into buckets when they should have been looking at the nuances
Yeah.
of their answers.
Exactly.
Okay, and that brings us to sampling.
Right.
Because, you can't analyze every single data point.
Especially with large companies.
Right, especially in a large company, right?
Right.
So talk about the importance of choosing the right sampling method.
Yeah, so choosing the right sampling method is crucial.
Yeah.
I once worked with a manufacturing company, and they were trying to assess the quality of their products,
Okay.
and they were using a convenient sample.
Okay.
They were just grabbing whatever products were closest to the inspection station.
Okay, easy.
Yeah, but that introduced a lot of bias
Uh-huh.
because the products that were closest to that station were often the ones that had already been flagged for, potential problems.
Oh, okay. So it wasn't truly representative
Yeah.
of the whole production run.
Exactly.
Okay, so that makes me think about all those online surveys that pop up,
Right.
How do you know if you're getting a biased sample?
Well, that's a great point.
Or if the questions themselves are leading,
Yeah.
leading people to certain answers?
It's important to be critical
Yeah.
about how that data is collected
Yeah.
and presented because, a beautifully designed graph
Right.
can be just as misleading as a poorly chosen sample.
Uh-huh.
And sometimes the most important insights come from really digging deeper into the data and asking, what's the story behind these numbers?
Yeah. Yeah. And speaking of bringing data to life,
Right.
I've seen them of your presentations.
Yeah.
You're like a master
Oh, stop it.
of turning spreadsheets into compelling visuals.
Oh, well, I believe that a good visual
Yeah.
can help cut through the noise and help people grasp these really complex concepts quickly.
Yeah.
But as you mentioned earlier, visuals can also be manipulated
Uh-huh.
to tell a particular story.
Right.
So it's really crucial to be aware of, that potential for bias.
Yeah, because a chart showing skyrocketing profits can be very persuasive,
Right.
even if it's based on a selective time frame
Yeah.
or excludes important context.
Right.
So let's talk about some of the common ways that data can be twisted,
Sure.
either intentionally or unintentionally.
Yeah, so one common tactic is manipulating the scale of a graph to exaggerate or downplay trends.
Okay.
I once saw a presentation where a company was, boasting about their impressive revenue growth,
Uh-huh.
but upon closer inspection, they had shrunk the axis
Oh, yeah.
to make a small increase look much larger.
Yeah, yeah, yeah. It's like taking a photo
Yeah.
from a low angle to make yourself look taller.
Exactly.
Yeah?
It's technically accurate,
Yeah.
but still misleading.
Right, exactly. Yeah. What other visual shenanigans
Well,
should we be on the lookout for?
another common tactic is cherry-picking data points
Okay.
to support a particular narrative.
Right.
So, for example, a company might highlight a few months of strong sales growth while ignoring a longer period of decline.
Oh, yeah.
Or they might focus on a particular customer segment
Right.
that's doing well. while ignoring others that might be struggling.
So it's all about context, right?
Exactly.
You need to see the full picture,
Yeah.
not just the carefully curated highlights.
And that's where critical thinking comes in.
Yeah.
Don't be afraid to ask questions,
Yeah.
challenge assumptions, and really dig deeper
Yeah.
into the data to uncover the real story.
So we've talked about data types, sampling, the importance of visualizing data responsibly. Now let's get to the heart of statistics, understanding the distribution of data and what those numbers actually tell us.
Right.
So, a lot of people get hung up on like the median,
Uh-huh.
but you've argued that it's not always the most informative measure.
You're right.
So tell me about that.
Yeah, so the median could be very misleading, especially when you're dealing with skewed data sets.
Okay.
And I remember I was working with a real estate developer,
Uh-huh.
and they were looking at median home prices
Yeah.
in a particular neighborhood.
Right.
And the median price was actually quite high,
Okay.
which would suggest that this was a really affluent area.
Right.
But when we dug a little deeper, we found that a few ultra-luxury property
Oh, yeah.
were actually skewing those results.
Oh, okay.
And the majority of the homes were actually much more affordable.
Interesting. So the median was painting a distorted picture of the typical home value
Exactly.
in that neighborhood. So what other measures of location might be more insightful in those kinds of situations?
Well, in cases where you have skewed data, the mean can sometimes be more representative of the typical value,
Okay.
even though it can be more sensitive to outliers.
Yeah, yeah,
And then you also have quartiles and percentiles,
yeah.
which can actually give us a more granular understanding
Right.
of the distribution, showing us where specific data points fall within the overall spread.
So it's about choosing the right statistical tools for the job
Yeah,
and not relying on like a single measure to tell the whole story.
exactly.
Now, let's talk about a concept that goes beyond, that simple average. Standard deviation. What makes this such an important tool for understanding data?
Well, standard deviations is all about variability.
Okay.
It tells us how spread out the data is around the average.
Uh-huh.
So a small standard deviation means that the data points are really clustered tightly around the mean,
Okay.
while a large standard deviation indicates greater variability.
Okay.
Yeah.
So why is that variability important? What does it tell us about the data we're analyzing?
Well, variability can be caused by, a multitude of factors,
Yeah.
and understanding the source of that variability is really crucial
Right.
for making informed decisions.
Yeah.
Like if you're a manufacturer and you're seeing a lot of variability in the dimensions of a particular part, that could indicate a problem with your manufacturing process.
Okay. So
Yeah.
you wouldn't just want to look at the average dimension
Exactly.
of the part. You'd also want to understand why. Some parts are deviating, significantly from the norm.
Exactly.
Okay, so what are some of the common sources of variability in business data?
Well, one common source is measurement error.
Okay.
If you're using different instruments
Uh-huh.
or techniques to measure the same thing, you're likely to get slightly different results.
Yeah.
Another source is natural variation.
Okay. Yeah.
Simply the inherent differences
Right.
that exist between individuals.
Like even with identical twins, there are subtle variations
Exactly.
in their physical characteristics.
Exactly.
So how do you distinguish between like measurement error
Right.
and natural variation when you're analyzing data?
That's where careful experimental design and statistical analysis come in.
Right.
You need to control for potential sources of measurement error
Uh-huh.
and use appropriate statistical tests to really determine
Right.
whether the observed variation is likely due to chance or to something more systematic.
Okay, so understanding variability is key for identifying patterns, spotting anomalies, and ultimately making better decisions.
Yeah.
Now, before we move on to the accounting portion of our deep dive, I want to touch on a concept that, bridges both statistics and accounting: probability. How does an understanding of probability help us make sense of financial data?
Well, probability is all about understanding uncertainty.
Okay,
And in the business world, there's always an element of uncertainty.
yeah,
Whether you're forecasting sales or, assessing the risk of an investment
right.
or making decisions about inventory levels, you're dealing with probabilities.
Right, so it's not just about crunching numbers, it's about understanding, like, the likelihood of different outcomes
Yeah,
and then making informed decisions based on those probabilities.
exactly.
Okay, so it's like playing poker.
Right.
You need to, know the odds and be prepared to make calculated risks.
Exactly.
Okay.
And that's where accounting comes in.
Yeah.
Accounting provides a framework for recording, analyzing, and interpreting financial data,
Uh-huh.
which allows us to actually assess those probabilities
Right.
and then make more informed decisions.
Okay, so let's shift gears now and dive into the world of accounting. So we've got these financial statements, income statements, balance sheets, statements of cash flows.
Right.
They can seem pretty daunting to the uninitiated.
They can.
So what's the best way to kind of approach these statements and make sense of the story they're telling?
Think of financial statements as pieces of a puzzle.
Okay.
Each statement provides a different perspective
Okay.
on the company's financial position
Uh-huh.
and performance. So the income statement, for example, shows how much profit the company generated over a period of time.
Okay.
The balance sheet provides a snapshot of the company's assets,
Right.
liabilities, and equity at a specific point in time.
Okay.
And then the statement of cash flows tracks the movement of cash in and out of the business.
Okay, so each statement tells part of the story.
Exactly.
And together they paint a more complete picture. But how do you actually analyze these statements and extract like meaningful insights?
That's where financial ratios come in.
Mm-hmm.
Ratios allow us to compare
Uh-huh.
different elements of the financial statements
Right.
and really assess the company's performance
Yeah.
in key areas
Okay.
like profitability, liquidity, and solvency.
Right, because $1 million in profit might sound impressive.
Right.
But it's even more impressive
Yeah.
if it was generated, with minimal debt
Right.
and a high return on equity.
Exactly.
So ratios help us kind of put those numbers in context.
Exactly. And by comparing a company's ratios
Yeah.
over time,
Yeah.
or to like industry benchmarks, we can really get a sense of its trends and identify potential red flags
Uh-huh.
or areas for, improvement.
Okay, so we've got our financial statements, our trusty ratios. What are some common pitfalls that people fall into when analyzing financial data?
One common mistake is focusing too much on a single number
Okay.
or a single ratio without considering the bigger picture.
Right.
So, for example, a company might have, a really high profit margin,
Okay.
but if their sales are declining,
Right.
that profit margin might not be sustainable.
Right. Okay.
Or, a company might have a low debt-to-equity ratio.
Uh-huh.
But if it's operating in a highly cyclical industry,
Right.
that low leverage might not be enough to
Weather the storm.
weather a downturn.
Yeah, yeah.
Exactly.
So it's about looking at the interplay of different factors.
Right.
And not getting too hung up on any one metric. What other traps should we be aware of?
Well, another common mistake is failing to consider the company's specific industry
Right.
and its stage of development. So a startup, for example, might have, negative profits
Yeah.
in its early years as it invests heavily in growth,
Yeah. Yeah. Right.
But that doesn't necessarily mean it's a bad investment.
Right.
Conversely, a mature company
Yeah.
in a slow growth industry
Uh-huh.
might have really high profits,
Yeah.
but limited growth potential.
So it's all about context,
Exactly.
right? The same financial numbers can tell very different stories depending on the circumstances. So what advice would you give to someone who's like just starting to learn about financial statement analysis? What are like the key things to keep in mind?
I'd say the most important thing is to develop a critical eye.
Yeah.
Don't just take the numbers at face value.
Right.
Really ask questions, challenge those assumptions,
Yeah.
and dig deeper to understand the story behind those numbers.
Right.
And don't be afraid to seek out, additional information beyond the financial statements, like industry reports, analyst opinions, and news articles.
Okay, so we've talked about the basics of understanding financial statements, using ratios to, analyze performance. But what about the day-to-day activities of a business?
Right.
How do we track the flow of money in and out of the company?
Exactly.
That's where transaction analysis comes in.
Exactly.
Yeah.
Transaction analysis is the foundation of accounting.
Okay.
It's all about understanding how every financial transaction
Yeah.
impacts the fundamental accounting equation.
Okay.
Assets equal liabilities plus equity.
Okay.
Yeah.
So every time like money changes hands, we need to understand how it affects
Right.
the company's assets, its liabilities, its equity. It's like a giant game of like financial Tetris
I love that.
where every transaction needs to kind of fit into the overall equation.
Right, exactly.
Mhm.
And while it may seem tedious, transaction analysis is really essential
Right.
for maintaining accurate financial records
Yeah.
and preventing errors.
Right, because even a small error can snowball into a big problem if it's not,
Exactly.
caught early on.
Exactly.
So let's talk about some common business transactions and how they're reflected in the accounting equation.
Sure.
So for example, let's say a company buys a new piece of equipment.
Right.
How would that be recorded?
Well, the equipment would be recorded as an asset on the balance sheet
Okay,
because it's something the company owns and controls.
right.
To pay for the equipment, the company might use cash,
Okay,
which would decrease its assets,
okay,
or they might take out a loan,
right.
which would actually increase their liabilities.
Okay. So every transaction has a dual impact
Exactly.
on the accounting equation. It's like a seesaw,
It is.
you
If
know,
one side goes up,
Yeah.
the other has to go down.
to keep it in balance.
Exactly, to keep it in balance.
Okay. Now let's talk about a transaction that's a bit more complex. Issuing shares of stock. How does that impact the accounting equation?
So when a company issues shares of stock, it increases its equity
Okay.
because the company is essentially selling ownership
Okay.
in the company in exchange for cash.
Right.
So the cash received from the sale of that stock
Yeah.
would increase the company's assets.
So issuing stock is a way for companies to raise capital
Exactly.
without taking on like debt.
Exactly.
But it also dilutes the ownership
It does.
of existing shareholders. So
Yeah.
it's like adding more slices
Yeah.
to a pie. Everyone gets a smaller piece.
That's a great way to think about it.
Now let's consider a transaction that's, a bit more routine, selling products or services.
Right.
How does that impact the accounting equation?
So when a company sells products or services, it increases its revenue,
Okay,
which is reported on the income statement.
right.
And the revenue generated from that sale would also increase the company's assets,
Okay.
either in the form of cash or accounts receivable if the sale was made on credit.
Okay, so a sale impacts both the income statement and the balance sheet.
Exactly.
It's all interconnected.
It's all connected.
Now, what about expenses? How are those recorded?
So expenses are recorded on the income statement,
Okay,
and they decrease the company's net income,
right.
and they can also decrease the company's assets
Okay,
if they're paid for in cash,
right.
or increase the company's liabilities if they're incurred on credit.
So expenses are the cost of doing business.
Exactly.
And they eat away at the company's profits.
Exactly.
Right. And that's why it's so important for businesses to carefully manage their expenses
Right.
and ensure that they're generating enough revenue to cover those costs
Right.
and generate, a profit.
Exactly.
Okay, we've covered a lot of ground today, from the fundamentals of statistics to the intricacies of transaction analysis. But there's one more topic I want to touch on before we wrap up this part of our deep dive. Uncollectible accounts. What are those and why do they matter?
Yeah, so uncollectible accounts,
Yeah,
or bad debts,
right.
are amounts owed to a company that are unlikely to be collected.
Uh-huh.
And this could happen for a variety of reasons, such as customer bankruptcy,
Yeah.
or, maybe a customer's unwillingness to pay.
So it's like lending money to a friend who never pays you back.
Exactly.
It's frustrating and it can hurt your bottom line.
And that's why it's important for businesses to have a process in place
Yeah.
for accounting for uncollectible accounts.
Yeah.
And that involves estimating the amount of bad debt that's likely to occur
Okay.
and recording an expense on the income statement
Right.
to reflect that estimate.
So it's about recognizing that not every sale will result in like a calf collection.
Exactly.
You need to kind of factor in
Yeah,
the risk of bad debt and adjust your financial statements
exactly.
accordingly.
And this is just one example of how accounting helps us make more informed decisions in the face of uncertainty.
Yeah.
Right.
Well said.
Thank you.
Okay.
You're welcome.
So we've talked about uncollectible accounts, which is basically planning for the possibility that some customers just won't pay.
Right.
But what about those big ticket items a company buys? Like buildings and equipment.
Right.
Those assets don't last forever, right?
You're thinking about long-lived assets. And you're right, they do wear out over time.
Yeah.
That's where depreciation comes in.
Okay.
It's the process of allocating the cost of those assets over their useful life.
So it's like spreading out the cost over the time you're actually benefiting from that asset.
Exactly.
But how do you decide how much to depreciate each year?
Right.
It's not like a car where you can just check Kelley Blue Book.
Right. There are different methods for calculating depreciation,
Okay.
each with its own logic and implications.
Okay.
One common method is the straight line method,
Okay.
which spreads the cost evenly over the asset's useful life.
Okay.
But sometimes the pattern of an asset's use doesn't match that neat straight line.
Right. Some assets might lose value more quickly in the early years.
Exactly.
Like that new car smell.
Exactly.
It fades fast.
Exactly. And for those assets, we might use an accelerated depreciation method,
Okay.
like the double declining balance method,
Okay.
which recognizes more depreciation expense in the early years and less in the later years.
Okay, so choosing the right depreciation method really depends on the nature of the asset and how it's used.
Right,
But why is depreciation so important from a financial reporting standpoint?
right.
It's not like the company is actually writing a check for that depreciation expense each year.
That's a crucial point. Depreciation is a non-cash expense,
Okay.
but it still impacts a company's financial statements.
Okay.
By recognizing depreciation expense, we're matching the cost of the asset
Okay.
to the revenue it helps generate
Right.
over time.
So it's about accurately reflecting the decline in the asset's value as it's being used up to generate revenue.
Exactly.
But depreciation also affects a company's tax liability, right?
Absolutely. The depreciation expense is tax deductible,
Okay.
which means it reduces a company's taxable income and therefore its tax liability.
Okay.
And this brings us to a really interesting intersection between accounting and tax.
Okay.
They're separate but intertwined systems.
It's like two sides of the same coin.
Exactly.
They need to understand both to
Right.
make informed financial decisions.
Exactly.
But sometimes it seems like accounting and tax rules are at odds with each other.
That's true. Accounting standards aim to provide a fair and accurate representation of a company's financial position
Okay.
and performance,
Yeah.
while tax laws are primarily concerned with raising revenue for the government.
Right.
And sometimes those objectives can lead to different treatments of the same transaction.
Okay, so it's not always a perfect alignment.
Right.
Can you give me an example of where those differences might arise?
Sure, let's consider depreciation again.
Okay.
Accounting standards might allow a company to depreciate an asset over a longer period,
Okay.
which would result in lower annual depreciation expense and higher reported profits.
Okay.
But tax laws might require a shorter depreciation period,
Uh-huh.
which would lead to higher annual depreciation expense
Okay.
and lower taxable income.
So the company might report a higher profit to its investors.
Right.
But a lower profit to the tax authorities.
Exactly.
That seems a bit counterintuitive.
It can be, and it highlights the need for companies to carefully navigate
Right.
the sometimes conflicting worlds of accounting and tax.
Okay, so we need to be aware of those differences and understand how they can impact a company's financial reporting
Right.
and tax liability.
Exactly.
Now let's shift gears and talk about a topic that's near and dear to my heart. Financial ratio analysis.
Okay.
I'm a bit of a ratio geek, always looking for those key metrics that unlock the secrets of a company's performance.
I like that.
So what are some of your favorite ratios to analyze and why?
I'm always interested in ratios that tell a story about a company's efficiency
Okay.
and its ability to generate cash flow.
Okay.
For example, the inventory turnover ratio
Okay.
tells us how quickly a company is selling its inventory.
Okay.
A high inventory turnover ratio suggests that the company is managing its inventory efficiently
Right.
and not tying up too much cash in stock.
Right, because holding excess inventory can be costly.
Exactly.
It's like having money sitting on a shelf gathering dust.
Exactly. And another ratio I like to look at is the days sales outstanding, or DSO,
Okay.
which measures how long it takes a company to collect its receivables.
Okay.
A low DSO indicates that the company is collecting its cash quickly,
Okay.
which is a good sign for its cash flow.
So if a company has a high inventory turnover ratio and a low DSO, it's a sign that they're managing their working capital effectively.
Precisely. And that brings us to a concept that's closely related to financial ratios,
Okay.
working capital management.
Okay, let's dive into that.
All right?
Working capital is basically the difference between a company's current assets and its current liabilities.
Yes.
It's the fuel that keeps the business running on a day-to-day basis.
You're right. It's the lifeblood of a business.
Yeah.
Having enough working capital is crucial for meeting short-term obligations,
Okay.
taking advantage of opportunities, and weathering unexpected storms.
Right.
But too much working capital can be a problem too.
Wait, how can having too much working capital be a bad thing?
Right.
Isn't it always better to have more cash on hand?
It might seem that way.
Yeah.
But tying up too much cash in current assets can be inefficient,
Okay.
like investing in growth opportunities
Right.
or returning value to shareholders.
So it's about finding that sweet spot.
Exactly.
Having enough working capital to operate smoothly, but not so much that it's dragging down returns.
Exactly.
It's like Goldilocks and the Three Bears. You want it just right.
Exactly. And managing working capital effectively involves striking a balance between several key components:
Okay.
cash accounts receivable, inventory, and accounts payable.
Okay, let's break those down.
Right.
We've talked about managing inventory efficiently
Right.
and collecting receivables promptly.
Right.
What about the other side of the equation, accounts payable?
Okay.
How do you optimize those?
Accounts payable represent the money a company owes to its suppliers.
Okay.
Managing accounts payable effectively is all about negotiating favorable payment terms,
Okay.
taking advantage of early payment discounts, and avoiding late payment penalties.
So it's like playing a strategic game with your suppliers.
It is.
You want to stretch out your payment terms as long as possible,
Right.
but without, damaging your relationship
Right.
or jeopardizing your creditworthiness.
Exactly. And it's important to remember that working capital management is an ongoing process.
Right.
Businesses need to constantly monitor their cash flow, adjust their strategies as needed,
Uh-huh.
and anticipate potential challenges.
Right, because the business environment is constantly changing.
Yes,
And what works today might not work tomorrow.
exactly.
Now, let's talk about a topic that's becoming increasingly important in today's complex business world. Disclosures.
Right.
I know it might seem like a dry topic,
Right.
but those footnotes and explanations in financial statements
Right.
can actually be quite revealing.
They're essential for providing context and transparency.
Okay.
Financial statements provide a snapshot of a company's financial position,
Okay.
but they don't always tell the whole story.
Right.
Disclosures help fill in the gaps,
Okay.
providing additional information that can help investors and other stakeholders make more informed decisions.
So it's like reading the fine print before you sign a contract.
Exactly.
You need to understand the details.
Yeah,
And the potential risks before you commit.
exactly. And disclosures can cover a wide range of topics,
Uh-huh.
from accounting policies and significant risks to upcoming events that could impact the company's financial future.
Okay, so disclosures are about transparency and accountability.
Yes,
But they can also be used strategically, right?
that's true.
A company can kind of use its disclosures to highlight positive information.
Right.
Or downplay negative information.
That's true, and that's why it's important to read disclosures critically.
Okay.
Don't just skim over them.
Yeah.
Pay attention to the language, use the level of detail provided, and any potential red flags that might be buried in the fine print.
So it's like playing detective looking for clues.
Exactly.
That might reveal more than the company wants you to see.
Exactly. And sometimes the most interesting information is found not in the numbers themselves,
Uh-huh.
but in the footnotes and explanations that accompany those numbers.
Okay, so we've covered the importance of disclosures.
Right.
And the need to read them critically.
Yes.
Now let's talk about a topic that's particularly relevant in today's dynamic business environment, managing a company's working capital.
Okay.
So you already touched on this a little bit,
Right.
but just to recap, working capital is essentially the difference between a company's current assets and its current liabilities.
Yes. It represents the resources a company has available
Okay.
to fund its day-to-day operations and meet its short-term financial obligations.
So it's like having enough cash on hand to pay your bills and keep the lights on.
Exactly. Now, managing working capital effectively is crucial for any business.
Yeah.
Regardless of its size or industry,
Okay.
too little working capital can lead to cash flow problems, missed opportunities, and even bankruptcy.
Right.
On the other hand, too much working capital can tie up valuable resources that could be used for investment or growth.
So it's all about finding that sweet spot.
Precisely.
Having enough working capital to operate smoothly,
Right.
but not so much that it's sitting idle.
Exactly. And our accounting textbook provides some great insights into the key components of working capital,
Okay.
including cash accounts, receivable inventory, and accounts payable.
Okay, let's break those down one by one.
Okay.
We all know cash is king.
Yes.
But how do accounts receivable fit into the picture?
Accounts receivable represent the money a company is owed by its customers for goods or services that have already been delivered or rendered.
Okay.
Managing accounts receivable effectively is all about striking a balance
Okay.
between extending credit to customers to encourage sales and collecting payments promptly to avoid cash flow problems.
Right, because a sale isn't a sale until you get paid.
Exactly.
Now, what about inventory?
Okay.
That seems like a big part of working capital, especially for businesses that sell physical goods.
Absolutely. Inventory represents the raw materials, work in progress, and finished goods a company has on hand.
Okay.
Managing inventory effectively is crucial for minimizing storage costs, reducing waste,
Okay.
and ensuring that you have enough product on hand to meet customer demand
Yeah,
without tying up too much cash.
makes sense. And lastly, we have accounts payable.
Right.
How do those play into working capital management?
Accounts payable represent the money a company owes to its suppliers for goods or services it has purchased on credit.
Okay.
Managing accounts payable effectively is all about negotiating favorable payment terms, taking advantage of early payment discounts,
Okay.
and avoiding late payment penalties.
So it's all about balancing the inflow and outflow of cash
Exactly.
to ensure a healthy working capital position.
Exactly. Now, there are a variety of tools and techniques
Okay.
companies can use to manage their working capital effectively.
Okay.
These might include implementing a cash budgeting system, establishing a line of credit tightening credit policies, offering early payment discounts, using factoring to convert receivables to cash, implementing a just-in-time inventory system, using inventory tracking software, negotiating longer payment terms with suppliers, taking advantage of early payment discounts from suppliers, and using supply chain financing.
This is getting pretty complex.
It can be.
Can you give me some real-world examples of how these techniques are used?
Of course.
Okay.
Let's start with cash management. A company might implement a cash budgeting system to forecast its cash inflows and outflows, ensuring that it has enough cash on hand to meet its obligations.
Right.
They might also establish a line of credit with a bank to provide a safety net in case of unexpected expenses.
Smart move. What about accounts receivable management?
A company might implement stricter credit policies to reduce the risk of bad debts,
Okay.
or offer early payment discounts to encourage customers to pay their invoices promptly.
Right.
They might also use factoring, which involves selling their accounts receivable to a third party at a discount
Oh, okay.
to access cash more quickly.
Interesting. And what about inventory management?
A company might implement a just-in-time inventory system to minimize storage costs and reduce the risk of obsolescence.
Okay.
They might also use inventory tracking software to monitor stock levels and identify slow-moving items.
Okay. And lastly, for accounts payable, are there any specific techniques that can help businesses manage those effectively?
Absolutely, a company might negotiate longer payment terms with its suppliers to improve its cash flow,
Okay.
or take advantage of early payment discounts to reduce its costs.
Right.
They might also use supply chain financing, which involves getting a third party to pay its suppliers on its behalf,
Okay.
allowing it to extend its payment terms.
Wow, there's a whole world of strategies and tools for managing working capital effectively.
There is, and it's an ongoing process,
Yeah.
requiring companies to constantly monitor their financial position and adjust their strategies as needed.
Okay, so we've covered the importance of disclosures and the complexities of working capital management.
Right.
Is there anything else we need to know about accounting in a business context?
Well, let's talk about something that's essential for making sound financial decisions: understanding and analyzing a company's financial performance.
Okay, so it's not enough to just record transactions and generate financial statements. We also
Yes.
need to kind of dig deeper
Yes,
and interpret those numbers.
exactly, and that's where financial statement analysis comes into play. It involves using a variety of techniques to assess a company's profitability, liquidity, solvency, and efficiency.
Profitability, liquidity, solvency, that sound like pretty important concepts.
They are.
Can you explain what each of these means in the context of financial performance?
Of course, profitability refers to a company's ability to generate earnings from its operations.
Okay.
Liquidity refers to a company's ability to meet its short-term financial obligations.
Okay.
Solvency refers to a company's ability to meet its long-term financial obligations.
Okay.
And efficiency refers to how effectively a company is using its resources.
Okay, so these four areas, profitability, liquidity, solvency, and efficiency, provide a comprehensive picture of a company's financial health.
Precisely, and there are a variety of tools and techniques we can use to analyze these areas,
Okay, like what?
including horizontal analysis, vertical analysis, ratio analysis, comparative analysis, common size analysis, trend analysis, and industry analysis.
Wow, that's a lot of tools.
It is.
Can you give me some specific examples of how these techniques are used in practice?
Sure, let's start with horizontal analysis, which involves comparing a company's financial statements over a period of time
Okay.
to identify trends and changes in performance.
Okay.
For example, we might look at how a company's revenue has grown or declined over the past 5 years,
Right.
or how its profit margin has changed.
So it's about spotting patterns
Yes,
and understanding how the company's financial story is unfolding over time.
exactly. What about vertical analysis?
Okay, what's that?
Vertical analysis involves expressing each item on a financial statement as a percentage of a base amount.
Okay.
For example, we might express each expense item on an income statement as a percentage of total revenue
Okay.
to see how much of the company's revenue is being consumed by each expense category.
Interesting. So it's a way to see the relative proportions of different financial elements?
Exactly. Now, what about ratio analysis?
Ratio analysis, that one sounds familiar,
It might.
but I'm not sure I fully understand it.
Ratio analysis involves calculating and interpreting financial ratios to assess a company's profitability, liquidity, solvency, and efficiency.
Okay.
For example, we might calculate a company's current ratio to see how easily it can cover its short-term debts,
Right.
or its debt-to-equity ratio to assess its financial leverage.
Ah, ratios are those financial detectives that help us uncover hidden insights?
Exactly. What about comparative analysis?
Okay, what's that one?
Comparative analysis involves comparing a company's financial performance to that of other companies in the same industry,
Oh,
or
okay.
to industry averages.
Okay.
This helps us assess how the company stacks up against its competitors and identify areas where it might be outperforming or underperforming.
So it's about benchmarking the company's performance
Yes,
and understanding its competitive position.
exactly. Now, what about common size analysis?
Okay, what is that?
Common size analysis is similar to vertical analysis,
Uh-huh.
but instead of expressing each item as a percentage of a base amount within a single financial statement, it involves expressing each item as a percentage of a base amount across different time periods.
Okay.
This helps us see how the composition of a company's assets, liabilities, or expenses has changed over time.
Okay, so it's another way to identify trends and changes in financial performance.
Precisely. Now, what about trend analysis?
Trend analysis, isn't that similar to horizontal analysis?
Trend analysis is a specific type of horizontal analysis
Okay.
that focuses on identifying long-term patterns in financial performance.
Okay.
For example, we might look at how a company's revenue has grown over the past 10 years to see if there's a consistent upward or downward trend.
Ah, so it's about taking a long-term view of the company's financial story.
Exactly. Now, what about industry analysis?
Okay.
Industry analysis involves understanding the specific dynamics of the industry in which a company operates.
Right.
This might include factors such as the level of competition, the rate of technological change, and the regulatory environment.
Okay.
This information can help us understand the context in which a company is operating and interpret its financial performance accordingly.
So it's about seeing the bigger picture and understanding how external factors might be influencing the company's results.
Exactly, and keep in mind that these different techniques are often used in combination
Yeah.
to provide a more comprehensive and nuanced understanding of a company's financial performance.
Right. It's like using multiple lenses to get a clearer picture.
Exactly.
All right, so we've got a whole toolbox of techniques for analyzing financial statements and interpreting the numbers.
We do.
But what about those times when a company's financial performance is less than stellar?
Right.
What happens then?
That's a great question. When a company faces financial challenges, it might need to consider a process known as restructuring.
Restructuring, that sounds a little intense. What does it actually involve?
Restructuring essentially involves making significant changes to a company's operations, finances, or organization
Okay.
to improve its financial performance or address underlying problems.
So it's like hitting the reset button and trying to get the company back on track.
Exactly. Now, there are a variety of reasons why a company might need to restructure,
Like what?
including declining profitability, excessive debt, industry disruption, changes in profit demand, or poor management.
Wow, those are some pretty serious challenges.
They can be.
So what are some common types of restructuring activities?
They can range from relatively minor adjustments to major overhauls depending on the specific circumstances.
Okay.
Here's a few examples: cost-cutting measures, asset sales, debt, refinancing, layoffs, mergers and acquisitions, divestitures, and bankruptcy.
Okay, this sounds like pretty significant changes.
They can be.
What are the goals of restructuring?
The ultimate goal is to improve the company's financial performance and ensure its long-term viability.
Okay.
This might involve reducing costs, improving efficiency, increasing revenue, strengthening the balance sheet, or enhancing competitiveness.
So it's about fixing what's broken, becoming more efficient, and ultimately ensuring the company's survival.
Exactly. Now, restructuring can be a complex and challenging process, and it doesn't always guarantee success.
Right.
But in many cases, it can be a crucial step for companies facing financial difficulties.
All right, so restructuring is a potential solution for companies facing serious challenges.
Yes,
It's about making tough choices and implementing changes to turn things around.
precisely. Now let's shift gears and talk about a topic that's particularly relevant for companies operating in a globalized economy: foreign currency transactions.
Oh, yeah, with businesses buying and selling goods and services across borders,
Right?
foreign currency transactions are becoming more and more common.
Absolutely. And it's not just large multinational corporations that are affected.
Right.
Even small businesses might need to deal with foreign currencies if they import supplies, export products, or have customers or suppliers in other countries.
So what's the big deal with foreign currency transactions?
Right.
What makes them different from regular transactions in our own currency?
Well, the key difference is that exchange rates fluctuate constantly.
Okay.
The value of one currency relative to another can change from day to day or even from minute to minute.
Right.
This can create both opportunities and challenges for businesses involved in international trade.
Ah, so it's like playing a financial game of chance.
It can be, can you give me some real-world examples of how these fluctuating exchange rates can impact businesses?
Sure.
Imagine you're a U.S.-based company that imports goods from Europe.
Okay.
If the value of the euro strengthens against the dollar, Your imports will become more expensive, potentially squeezing your profit margins.
Okay.
On the other hand, if the value of the dollar strengthens against the euro, your imports will become cheaper, potentially boosting your profits.
So it's a bit of a roller coaster ride for businesses dealing with foreign currencies.
It can be. And here's another example. Let's say you're a Canadian company that sells products to customers in the United States.
Okay.
If the value of the Canadian dollar weakens against the US dollar, your sales revenue will be worth less when you convert it back into Canadian dollars.
Right.
On the other hand, if the value of the Canadian dollar strengthens against the US dollar, your sales revenue will be worth more when you convert it back.
Okay, I see how these fluctuating exchange rates can create a lot of uncertainty for businesses.
Right.
So how do companies manage this risk?
Well, there are a variety of strategies they can use,
Like what?
including natural hedging, foreign currency forward contracts, foreign currency options, leading and lagging payments, and maintaining a foreign currency bank account.
Those sound like some smart strategies.
They can be.
Can I break down each of these in a little more detail?
Of course, natural hedging involves structuring your business operations in a way that naturally reduces your exposure to exchange rate fluctuations.
Okay.
For example, if you have both revenues and expenses in a foreign currency, the gains and losses might offset each other to some extent.
So it's like having a built-in buffer against currency swings.
Exactly. Now, foreign currency forward contracts involved locking in a specific exchange rate for a future transaction. This allows you to eliminate the uncertainty of exchange rate fluctuations, but it also means you won't benefit if the exchange rate moves in your favor.
So it's like buying insurance against currency risk.
That's a good analogy now. Foreign currency options give you the right, but not the obligation,
Okay.
to buy or sell a foreign currency at a specific exchange rate on or before a certain date.
Okay.
Options provide more flexibility than forward contracts because you can choose whether or not to exercise them, depending on how the exchange rate moves.
Interesting. So options give you more control, but
Yeah.
typically cost more than forward contracts.
They do. What about leading and lagging payments?
Okay, what's that?
Leading involves paying your foreign currency liabilities early if you expect the foreign currency to strengthen,
Okay.
and lagging involves delaying payments if you expect the foreign currency to weaken.
Okay.
These strategies can help you take advantage of favorable exchange rate movements,
Right.
but require careful forecasting and planning.
So it's all about timing your payments strategically.
Exactly. Now, what about maintaining a foreign currency bank account?
Okay.
If you regularly transact business in a foreign currency,
Right.
it might make sense to maintain a bank account in that currency to avoid the costs and hassle of constantly converting currencies.
Right.
This can also allow you to take advantage of local investment opportunities.
Okay, so there's a whole range of strategies for managing foreign currency risk.
There is, and it's crucial for businesses to carefully assess their exposure to exchange rate fluctuations
Right.
and choose the strategies that best align with their specific needs and risk tolerance.
All right, so we've explored the complexities of foreign currency transactions and the strategies businesses use to navigate them.
Indeed. And now let's dive into a topic that's becoming increasingly relevant in the digital age: accounting for cryptocurrencies.
Ooh, crypto, that's a hot topic these days.
It is, and it's raising a lot of questions about how traditional accounting principles should be applied to this new and evolved asset class.
Yeah, because cryptocurrencies aren't exactly like traditional currencies or investments, are they?
They're not, and that's what makes accounting for them so challenging.
Okay, let's start with the basics. How are cryptocurrencies actually defined from an accounting perspective?
Well, that's where things get a little tricky.
Okay.
There's no universally accepted definition yet.
Okay.
But generally, cryptocurrencies are being treated as intangible assets.
Intangible assets, so it's like a patent or a trademark?
In a way, yes, intangible assets are assets that lack physical substance but still hold value.
Okay, so we're treating crypto as an intangible asset.
Right,
But how do we actually measure its value?
right.
The prices of cryptocurrencies are notoriously volatile.
That's one of the biggest challenges.
Yeah.
Currently, there are two main methods for valuing cryptocurrencies:
Okay.
the cost method and the fair value method.
Okay, so the cost method is pretty straightforward. You just record it at what you paid for it.
Exactly.
But what about the fair value method?
Right.
How do you determine the fair value of something as volatile as cryptocurrency?
That's where things get a bit more complex. The fair value is typically determined by reference to an active market,
Okay.
such as a cryptocurrency exchange.
Okay.
However, not all cryptocurrencies are traded on active markets,
Right.
and even those that are can experience significant price swings.
So there's a lot of subjectivity involved in determining the fair value of cryptocurrencies.
There can be, and that's why accounting for cryptocurrencies is still a work in progress.
Right.
Accounting standards are constantly evolving to keep up with the rapid pace of innovation in the crypto space.
So it's a bit of a moving target.
It is. is, but it's an exciting and fascinating area of accounting
Yeah.
with a lot of potential for growth and development.
All right, I'm ready for another challenge. What other unique accounting considerations are there when dealing with cryptocurrencies?
Well, one of the biggest issues is revenue recognition.
Okay.
When is it appropriate to recognize revenue from cryptocurrency transactions?
Yeah, because with traditional goods or services, it's usually pretty clear when the revenue should be recorded.
Exactly. But with cryptocurrencies, things can be a little more ambiguous.
Okay.
For example, if you're a business that accepts payment in cryptocurrency,
Right.
when should you recognize that revenue?
Yeah.
When you receive the cryptocurrency,
Okay.
when you convert it to fiat currency,
Right.
or at some other point in
Those
time?
are some tricky questions.
They are, and there's no one-size-fits-all answer.
Right.
The appropriate revenue recognition method will depend on the specific facts and circumstances of each transaction.
Okay, so revenue recognition is one challenge. What about tax implications?
Right.
Cryptocurrency is still a bit of a gray area from a tax perspective, isn't it?
It is tax laws and regulations around cryptocurrencies are still evolving,
Right.
and they vary significantly from country to country.
Yeah.
Businesses need to stay informed about the latest developments and work closely with tax professionals
Uh-huh.
to ensure they're complying with all applicable rules.
Sounds complicated.
It can be, but it's important to remember that cryptocurrencies are here to stay,
Right.
and accounting professionals need to be prepared to handle the unique challenges they present.
All right, so we've covered the basics of accounting for cryptocurrencies, including the challenges of valuation, revenue recognition, and tax implications.
Indeed. And now let's shift our focus to a topic that's essential for any business looking to grow and expand: analyzing investment opportunities.
Investment opportunities, that sounds like a good thing. Tell me more.
Of course, businesses are always looking for ways to invest their resources to generate future profit and create value for their shareholders.
Right.
But not all investment opportunities are created equal.
So how do businesses go about analyzing investment opportunities to determine which ones are worth pursuing?
Well, there are a variety of financial tools and techniques they can use,
Like what?
including net present value, or NPV, internal rate of return, or IRR, payback period accounting rate of return, or ARR, and qualitative factors.
Wow, that's a lot of tools. And you give me some real-world examples of how these tools are used in practice?
Sure, let's start with net present value, or NPV, which is a technique for calculating the present value of future cash flows discounted at a specific rate of return.
Okay.
If the NPV of an investment is positive, it's generally considered to be a good investment.
Okay.
If it's negative, it's generally considered to be a bad investment.
Okay, so MPV helps us understand the time value of money
Right.
and whether an investment will generate a positive return over time.
Exactly. What about the internal rate of return, or IRR?
Okay, what's that?
The IRR is the discount.
Okay, so the percentage of completion method helps smooth out the bumps in recognizing revenue and expenses for these long-term projects. Seems pretty straightforward in theory, but I imagine there are some tricky judgment calls involved when you're dealing with estimates and projections that could change over time.
You're absolutely right. Accurately estimating the total costs and revenues for a project that might span years is one of the biggest challenges with this method.
Yeah, it's not like you have a crystal ball to see into the future. What are some of the techniques companies use to make those estimates as accurate as possible, especially when so much can change over the course of a long-term contract?
Well, it all starts with meticulous planning and documentation. Breaking down the project into smaller, manageable phases with clearly defined deliverables allows for more accurate cost and revenue projections for each stage. And regularly reviewing and updating those estimates as the project progresses is crucial.
So it's like building a house. You start with a blueprint, but you have to be prepared to make adjustments along the way as unexpected issues arise or as the client's needs evolve.
That's a great analogy. And just like a skilled builder relies on experience and expertise to anticipate potential problems, a good project manager will factor in contingency reserves to account for unforeseen costs or delays.
Right, because even with the best planning, there's always a chance of cost overruns or unexpected delays. But isn't there a risk that these estimates could be manipulated either intentionally or unintentionally to paint a rosier picture of a company's financial performance?
That's definitely a valid concern. That's why strong internal controls, independent audits, and transparent reporting practices are so crucial to maintaining the integrity of the percentage of completion method.
It's like a system of checks and balances to make sure everyone is playing by the rules. Now, shifting gears a bit, let's imagine we're wearing the hat of an investor who's looking at a company's financial statements. What are some of the red flags that might jump out and make us question the company's accounting practices or the accuracy of its reported numbers?
One thing I always look for are sudden or unexplained changes in key financial ratios. For example, if a company's gross profit margin suddenly spikes without a clear explanation, it might be a sign that something is amiss. It could be legitimate, like a shift to higher margin products, but it warrants further investigation.
So it's about looking for those outliers, those numbers that don't quite fit the overall trend. It's like spotting a crooked picture frame in an otherwise perfectly aligned gallery wall. It just catches your eye.
Exactly. Another red flag is a significant discrepancy between a company's reported profits and its cash flow. If a company is reporting strong profits but struggling to generate cash, it could be a sign of aggressive revenue recognition practices or problems with collecting receivables.
So it's about looking beyond the surface and understanding the quality of a company's earnings, not just the quantity. What other warning signs should investors be on the lookout for?
Keep an eye out for excessive debt levels, especially if the company is operating in a cyclical or volatile industry. High debt can amplify both gains and losses, making the company more vulnerable to economic downturns or unexpected challenges.
So it's about assessing the company's financial resilience, its ability to withstand shocks and stay afloat even when the seas get rough.
Precisely. And don't underestimate the power of qualitative factors like the quality of the company's management team, its competitive landscape, and its long-term growth prospects. Numbers tell a story, but it's often the human element, the strategy, and the vision that determine a company's ultimate success or failure.
Right, because even the most impressive financial statements can be misleading if the company is led by a team of incompetents or if its core business model is about to be disrupted. It's like investing in a beautiful ship with a leaky hull. It might look great at the dock, but it's not going to sail very far.
That's a great way to put it. Investing is not just about crunching numbers. It's about understanding the whole picture, the good and the bad, the risks and the rewards. And that's what makes it both challenging and fascinating.
Well, this deep dive has certainly been an eye-opener. We've explored a wide range of topics from the foundations of statistics and accounting to the complexities of financial analysis and investment decision-making.
It's been a pleasure sharing these insights with you. Remember, the world of business and finance is constantly evolving, so it's crucial to stay curious, keep learning, and always be willing to challenge assumptions.
That's great advice. And for our listeners, if this deep dive has piqued your interest, we've included links to the resources we've discussed in the show notes. Until next time, happy exploring.